How to hedge against inflation with strategic investments. Imagine waking up one day to find that your hard-earned savings can buy significantly less than it did a year ago. Groceries cost more, fuel prices have skyrocketed, and the money in your bank account is eroding in value. This is not a nightmare. It's inflation at work. Inflation silently chips away at your purchasing power, making it crucial to protect your wealth with smart investment strategies. Hedging against inflation isn't about reacting to economic downturns. It's about proactive financial planning. Strategic investments can help preserve and even grow your wealth in times of rising prices. In this comprehensive guide, we'll explore the best investments to combat inflation and practical steps to implement them effectively. 1. Understanding inflation and its impact on investments. Definition of inflation. Inflation is the rate at which the general level of prices for goods and services rises, eroding purchasing power. Causes of inflation. Inflation can result from increased demand, supply chain disruptions, excessive money supply, or geopolitical factors. How inflation affects your wealth. Fixed incomes lose value, savings shrink, and investments in cash-based assets become less effective over time. Historical trends. Looking at historical inflation trends can provide insights into how different asset classes have performed in past inflationary periods. Types of inflation, demand pull, cost push, and built-in is crucial for selecting effective hedging strategies. Demand pull inflation occurs when consumer demand exceeds supply, driving prices higher. Cost push inflation results from rising production costs such as wages or raw materials, leading businesses to increase prices. Built-in inflation is a self-sustaining cycle where expectations of future inflation cause wages and prices to rise continuously. Recognizing these inflationary forces helps investors and policymakers implement tailored strategies, such as investing in inflation-protected securities, commodities, or adjusting interest rates to maintain economic stability. 2. Key characteristics of inflation-proof investments. For an investment to hedge effectively against inflation, it should appreciate over time. The asset should increase in value in proportion to or greater than inflation. Hold intrinsic value. Tangible assets like real estate and gold are excellent examples. Generate income, dividends, rental income, and interest payments help maintain purchasing power. Provide diversification. A balanced portfolio reduces risk and enhances financial stability. Liquidity. Considerations. Some assets may provide excellent returns, but have limited liquidity, which can affect accessibility during market downturns. Global investment exposure. Investing in international assets helps diversify risk beyond domestic inflationary trends. 3. Strategic investment options to hedge against inflation. A. Real assets. I. Real estate. Property values typically increase over time. Rental properties generate passive income. Real estate investment trusts, REITs, allow indirect real estate investing with liquidity benefits. Real estate often outpaces inflation due to demand for housing and commercial properties. Investors can leverage real estate to build equity over time while benefiting from rental appreciation. 2. Commodities, gold and silver, traditional stores of value that hedge against currency devaluation. Agricultural and energy commodities. Investing in commodities like oil, wheat, and natural gas can offer protection. Commodity ETFs, a convenient way to gain exposure without directly handling commodities. Industrial metals, copper, aluminum, and other metals play a critical role in industries and can benefit from inflation-driven demand. B. Financial assets. Why stocks and equities? Sectors like energy, healthcare, and consumer staples tend to perform well in inflationary periods. Dividend-paying stocks provide passive income that outpaces inflation. Companies with strong pricing power can maintain profitability despite rising costs. Investing in growth stocks can provide capital appreciation that outstrips inflation over time. Index funds and ETFs. These offer broad exposure to inflation-resistant sectors with lower management costs. 2. Inflation-protected bonds. Treasury inflation-protected securities. TIPS are government-issued bonds designed to protect investors from inflation. Their principal value adjusts according to changes in the Consumer Price Index, CPI, ensuring that both the principal and interest payments keep pace with rising prices. This makes TIPS a reliable option for preserving purchasing power over time. Series 1 savings bonds provide a dual benefit by combining a fixed interest rate with a variable rate that adjusts every 6 months based on inflation, ensuring that your savings maintain their purchasing power over time. Corporate bonds with inflation adjustment clauses safeguard investors by linking interest payments or principal value to inflation indices, ensuring returns keep pace with rising prices and preserving purchasing power. Municipal bonds with tax benefits help protect against inflation by offering tax-exempt interest, which enhances real returns. Certain bonds, like revenue bonds tied to essential services, may also benefit from inflation-driven price increases, adding stability to investments. 3. Exchange-traded funds, ETFs, and mutual funds. Commodity-backed ETFs offer direct exposure to inflation-resistant assets like gold, oil, and agricultural products. They help protect purchasing power while providing liquidity and diversification. Sector-specific ETFs target industries like energy, commodities, and consumer staples, which tend to perform well during inflationary periods. These ETFs help investors capitalize on rising prices while offering diversification within inflation-resistant sectors. Actively managed mutual funds have the flexibility to reallocate assets in response to inflationary trends. Fund managers can shift investments toward commodities, inflation-protected securities, and industries that historically perform well during rising prices, helping to preserve purchasing power and optimize returns. C. Alternative investments. I. Cryptocurrency and blockchain investments. Bitcoin is often referred to as digital gold. Crypto assets can offer protection against currency depreciation but come with high volatility. Stable coins backed by real-world assets can provide an alternative inflation hedge with reduced risk. Decentralized finance, DeFi platforms offer new investment opportunities beyond traditional markets. 2. Private equity and venture capital. Investing in high-growth startups can yield significant returns. Hedge funds employ inflation hedging strategies. Private market investments often have lower correlation to traditional stock and bond markets. 3. Foreign currencies and global investments. Holding assets in stronger or more stable foreign currencies provides an alternative store of value. Investing in international markets with better inflation control can be beneficial. Emerging market investments offer high growth potential but carry additional risks. 4. Practical strategies for implementing inflation hedging investments. Diversification. Spread investments across different asset classes to minimize risk. Risk management. Maintain a balance between high return and stable investments. Portfolio rebalancing. Adjust your holdings based on market conditions. Focus on income-producing assets. Passive income can offset inflation's effects. Tax efficiency. Consider tax-friendly investment vehicles to maximize returns. Utilizing leverage wisely. Borrowing at fixed rates can be advantageous in inflationary environments. Staying informed. Regularly reviewing economic trends and adjusting your portfolio accordingly ensures effective inflation hedging. 5. Risks and challenges of inflation hedging. Market volatility. Stocks, commodities, and cryptocurrencies can be unpredictable. Liquidity issues. Some inflation-resistant assets like real estate are difficult to sell quickly. Over-reliance on a single asset. A well-balanced approach is necessary to avoid unnecessary risks. Government policy risks. Changes in monetary and fiscal policies can impact investment outcomes. Unexpected economic shifts, global crises, wars, and trade disruptions can alter inflation trends unexpectedly. 6. Conclusion: inflation is an inevitable economic force, but it doesn't have to erode your wealth. By strategically investing in inflation-resistant assets like real estate, commodities, stocks, and alternative investments, you can safeguard your financial future. Diversification, risk management, and proactive investment planning are key to maintaining purchasing power and securing long-term financial stability. 7. Call to action. Don't wait for inflation to diminish your savings. Take action today. Evaluate your portfolio, consult with a financial advisor, and incorporate inflation hedging investments to ensure your wealth remains intact. 8. Subscription and engagement. If you found this guide valuable, subscribe for more expert insights on wealth protection and smart investing. Stay ahead of financial trends and take control of your financial future today. Share this with others who need to protect their wealth against inflation.